We had shifting economic expectation with some analysts starting to increase their probability of recessions.
Welcome to the 5th episode of Kurv Your Enthusiasm. We are your hosts, Howard Chan.
Dominique, Tersin.
This podcast is a discussion of everything relating to investing and everything adjacent to it. It is important to remind the listener that the trades we discuss on the show are not meant to be financial advice. We are recording this on April 1st. No joke. On the agenda today, we will go through our market update since we last recorded 2 weeks ago. Then we're going to go revisit the last topic on our last podcast, which is sort of my unifying theory about what the Trump administration is doing in terms of their policies. Maybe a little bit of an analysis on how well they're doing. And then we go into the second part of discussion on volatility and how you can use it in your portfolio. And in particular, we're going to talk about what the trades or how you can use this particular risk premia to generate returns in your portfolio. All right. Well, Dom, give us a market update.
Sure. Well, over the past 2 weeks, we had continuous trade tensions. We had the 25% extra tariffs on autos non-manufactured in the US. We had shifting economic expectation with some analysts starting to increase their probability of recessions. And on top of that, we had rather sticky inflation numbers, basically too high for the Fed to cut quickly if there will be a recession. So that's kind of stagflation theme, which actually was still present when we did the last podcast. And that can explain why the risk assets suffered for the past 2 weeks. We can see S&P is down today and yesterday. It's a little bit better, but down 1% past 2 weeks. And it's actually the worst quarter since 2020. The Nasdaq is down 3%. And there was some rotation again out of the tech sectors and the large names into the rest. Although the pace has abated recently. Flight to safety, it's still visible through the VIX that has increased again, 23. It's on the high level of the range. Usually the range is around 14 to 23. So we are at 23. And also we can see on the flight to safety bonds. Bonds did okay this past week. 10-year is down. It's not much, but still. And the Fed fund futures in December, so the expectation of Fed fund rates for December is also down by 10 basis points. I believe it's pricing around 3 cuts this year, with the one starting probably in June. Probability is around 2/3. And on top of that, on the flight to safety, we have the usual on our podcast. It's gold plus 3%. Again, it's the ultimate edge, it seems. Gloomy picture from the market and also from the macro indicators. The bias of the markets being more on the start of a clear cool down of the economy.
Well, you forgot to mention, tomorrow is April 2nd. It's Liberation Day, where apparently a lot of reciprocal tariffs are going to go live. You think they chose April 2nd because they didn't want to do it on April 1st?
I think so.
Everybody thinks it's a joke.
Yeah, well, marketing is important.
Yeah, so we're recording this on April 1st, and this episode will probably be out on April 2nd. So we're not responsible for what's going to happen in the market today when you're listening to this, and we'll have an update in 2 weeks to assess what has actually happened. I think what you are describing is something that we have been really talking about since we started this podcast, which is that inflation is still well maintained, rather high for historical standard, at least over the last 15 years. And we have now continuously gotten, I would say, progressively worse and worse news in terms of economic activity. And then, of course, there's increased uncertainties from US trade policy. The probability of a recession is increasing. And one of the concerns, and maybe risk from a risk management perspective, is that the market hasn't really priced in this increased probability of a recession.
Recently, Goldman put it at 30%, 35%.
Yeah, I think it may be higher. And so as a prudent investment managers, we want to be sure that we don't underestimate the underpricing of this recession, and then be able to protect the portfolio in case there is a downturn in the economic cycle. And that said, we do want to continuously to try to rationalize what is the Trump administration's policy and what is their aims. I think that's important to try to understand. I started doing that and explaining that, at least for our base case, last episode. And I think I did a pretty horrible job of describing what our model. So I'm going to try to do a second take. And I'm trying to maybe go from a broader theme to very specific items. And then we'll give a little bit of an assessment of how they're going about their goals. Since I would say the 60s and the 70s, when the Chinese market started opening up after Nixon, we've seen essentially an increasing trade imbalance through the world. It's essentially that China will make products for the world. China is producing goods not necessarily to maximize profit, but instead to gain market share. And so, as I mentioned last time, we've seen that they've done this with, solar panels and EVs. And this is destroying essentially manufacturing sectors in both Europe and the US. And we've seen further evidence of this is actually there's a recent report that big companies like Volkswagen are cutting hundreds and thousands of jobs because they're not producing as many cars anymore, largely because China is actually making inroads on selling their really cheap EVs to the rest of the world, crowding out German auto manufacturers. If you were in administration who's trying to combat this, you want to reverse the trade deficit. One way is to reduce trade with China, but that's not sufficient because the cycle continues, because when China has a trade surplus, they use some of that to subsidize their internal industries so that they don't have to be profit seeking. The government can support some of the profit making, and then all they have to do internationally is to try to get market share. So some of that trade surplus is used to subsidize internal production, but also to get foreign assets. China has about $1 trillion of trade surplus, of which US only accounts about a third of that trade. So if we're just to put tariffs on, that wouldn't be sufficient, because there's another 60% of trade surplus that China can source elsewhere from the world. EU accounts for about 250 billion of that trade surplus. And then India is the next largest at 100 billion. So between the US and EU, it accounts about 60% of the trade surplus that China has. I think what happens is the US government is trying to put tariffs to reduce trade with China, but they can't do it alone. They actually have to also somehow convince other regions to increase trade tariffs to reduce their trade with China as well. And we've seen them doing this with Canada and Mexico. I don't know if we necessarily need to be pushing everybody to do this, because obviously Europe has a big trade deficit also with China. So it is actually in their interest to protect some of their industry. I think this is the reversal of the globalization trend that we've seen in the last 40, 50 years, that again, we're going into regional trading zones so that not one single country can dominate and have such a huge trade surplus. And for those who are on the podcast, I'm pulling up an infographic from US Fact. This is from Steve Ballmer, the former CEO of Microsoft. He put together some of these data graphics that I think are very useful. The Trump administration is also trying to address the second deficit that we have, which is the budget deficit. And roughly, the problem is this, is that currently the debt to GDP of the US is roughly around 100. So 1-to-1 in terms of debt and economic growth. However, the numerator and the denominator are not growing at the same pace. US debt is growing roughly at about 7%, 6 to 7% per year, while US GDP is growing maximum at 3% a year. So which means that the debt is growing faster than our GDP by about 3% every year. And so we are actually in the time of essentially we're issuing more debt just to pay the interest on our debt. And that is not sustainable. And so in order to balance our budget deficit, we need to essentially either cut spending or increase revenue. Because if you look at the graphic right now, the US government is taking in roughly $5 trillion from taxes and everything, and then we're spending $6.8 trillion. So that means that we have to finance a budget deficit about 1.8 trillion every year. So that makes sense that you're looking for different ways in terms of cutting the budget, the US spending, right? And just to briefly talk about the US budget, the top 5 items that is being spent in the US is Social Security, which makes up about 22% of the spending, health services, which is about 13.5% of the spending, interest payment is 13% of our spending, Medicare is about 13% of the spending, and defense is about 13% of the spending. So these top 5 items make up about 75% of the US budget. The Trump administration is trying to look at different ways in which to decrease spending. I guess the obvious criticism is the places that they have cut, USAID, Department of Veterans Affairs, Department of Education, those are not really the large budget items. For instance, the Department of Federal Affairs is only 5% of the budget. Department of Education is only 4% of the budget. Agriculture is the next big one, which is at 3% of the budget, and USAID is somewhere even below that. So it's hard to see where they could find a $1.8 trillion savings in cutting those things. The things that needs to be cut or managed is a lot of the social programs, Social Security, health services, interest payment, they're working on that, Medicare. And those are really, really hard questions and hard decisions to make. And they have, at least in the past, publicly said that they are not going to make any changes to those. The one part is on the top 5 spend is the defense budget, which is 13% of the US budget. They are making some headways on that particular front by essentially making US allies paying a little bit more. So that part makes sense to me. But really, if you're going to try to balance this budget, you're going to have to do one of 2 things, which is one, you have to cut a lot of the social programs, which is highly unpopular. So I don't know how successful that would be. Or the second thing is you have to raise taxes to make up for that $1.8 trillion of deficit.
Or at least not decrease taxes, because it's expected to decrease taxes, I believe.
Yeah. Those are hard decisions. We're just trying to rationalize essentially what the policies are trying to do. We are still gauging how effective it is. We're kind of less than 100 days in. But this is the challenge, I think, for any government that's trying to really rebalance the dual deficit, the trade deficit, as well as the budget deficit. So Dom, what do you think about that?
I agree. On the China increasing market shares and profits, it makes sense. I mean, you just have to look at the Chinese stock market since 15, 20 years. It hasn't done much. I agree. You have to, at some point, you have to decrease the twin deficits, so the foreign and the domestic deficits, trade and budget. And the thing on the revenue side, in a way, with tariffs, you can increase the revenue. That's, I think, one of the arguments of the Trump administration. The question is how much? I don't know. But total imports, I think it's, where I'm reading, 3.3 trillion. So 20% is 600 billion, which is a third of the budget deficit.
Do you know how much the U.S. pay in interest payments on their debt? About 660 billion. So the tariffs will offset our interest payment.
It's a start.
Yeah.
But I don't think they will reach 600 billion in tariff. I don't think so. But in a way, I was looking at some charts, and it seems that the US have the lowest tariffs in the world, or one of the lowest. So if it increases from 2% to 6-8% in average, it will put them on what they had like 30, 40 years ago. It's not completely crazy, I think.
And there's for and against kind of column, right? And definitely tariff will be a revenue generator for the US government. I think the open question that I have is that it took 40 years for us to go to this globalized arrangement. I think it'd be very hard for us to reverse and to have regional trading zones in 1 or 2 years, maybe 10 to 15 years. So you're not going to get all of this revenue all at once. There's some time to get it, and at the same time, your debt is growing 3% faster than your GDP.
Yeah, it would be interesting to see if in 4 years, whoever takes over would have the same policy. But you mentioned something on the assets. So when a country exports to another country, it can take its currency back to its own country, or leave it to the importing country and to have assets there. That's usually what most people do, and that's why you have, I think China has 800 billion of treasuries, 300 billion of corporate debt, and I'm seeing out of the 1.3 trillion of equities and bonds that foreigners have, China is a good chunk. So as more trade deficit accumulates, that's more assets that you don't own anymore, right? Or you have to create them to sell them to the foreigners. So at one point it might be difficult to do.
Well, I have two comments on that, right? So in the last episode, I posited that part of what Treasury is trying to do by inducing a weaker economy is to drive the 10-year Treasury rates lower. And therefore, if we refinance our treasuries, then it would lower our interest burden. But the problem is that we have a lot of debt that were issued during very low rate environment. So I think the average interest rate on our U.S. debt is about like 3 to 3.5%. If we refinance now, even at a given rate, the rate right now in the 10-year Treasury is about 4.5, right? So if we refinance, we're actually increasing our interest burden. So we would really have to drive rate very low in order to get that benefit of extending maturities or refinancing at a lower rate, which have been talked about, this theory about this Mar-a-Lago Accord, but that seems to be difficult at this moment, right? And then the second thing is we have seen, as you mentioned, gold have reached an all-time high. And that's partially because a lot of central banks are basically storing gold instead of buying treasuries, right? So there is a question of, yes, China is a large holder of US treasuries in the past, but going into the future, as we issue more debt, who is going to buy these treasuries? And the people who are purchasing it has changed. About 10 years ago, it's largely institutional, central bank, and now more and more debt is actually being owned by private entities in the U.S. So that there's only so much, uh, that can hold in the U.S. market.
And one solution to the debt is to inflate it. In a way, tariffs helps.
Yes, so that is true. There's two ways in which you can solve that problem. One is you can grow out of it. That would require your GDP to grow at a faster rate than growing your debt, which is not the scenario that we have. And maybe one theory is that if you give a tax cut, that will induce growth and increase the GDP, so we can somehow uh, have real growth grow faster than debt accumulation. The other way to solve this is to actually increase inflation so that your debt is not worth as much as it was when you issued it. That is hard because we just came out of a highly inflationary period and governments changed because of high inflation. That is something that maybe a lot of politicians are afraid of going back, right, to do. Tariffs
So
will
yeah,
help because it is by its nature inflationary. You would, just to be on par with the growth of debt, you have to increase inflation another 3%, right? Right now, inflation is about 3%. So that means inflation has to be at about 6%. That's going to be pretty hard if you have an annual inflation rate of 6%
gold.
for any country. Exactly. And I think that's a good reason why gold keeps climbing higher.
Mm.
Yeah. So it's difficult. This framework makes sense to me in terms of what the administration is doing. The question is really about efficacy, right? If you are trying to decrease trade deficit, you actually want to have trade with your allies because you need, if you're trying to bring back manufacturing jobs in whatever form they have, though there's some questions about how many manufacturing jobs you can actually onshore again, you want to create products that is uh, being purchased domestically, and you want to actually export those products. You need to have friends who want to trade with you on those products, right? So I think over time, there will be deals that will have to be put in place where we have mutual trade agreements. The easiest would be the neighbors to the north and south of the US, Canada and Mexico. And then the next would be to the Eurozone. So I think long term we'll see maybe a cool down of the tariff wars, because if it's true that we want to change the trade deficit in the US, we have to be exporting more, right? Not net positive, but at least exporting more. And you have to trade with people. Um, and people tend not to want to trade with you if you are threatening them with things. And with the budget deficit, that's a really hard question in terms of implementation, because the cuts will have to come from things that are very unpopular. That's to decrease spending. And then the thing that's not really being talked about, which is equally difficult, is you have to increase revenue. And I think for most of the world, increasing taxes is not popular. So it will be to be seen how much pain can a population take before the government change to go in a different direction.
Coming from France, you have a lot of room.
I think that's why people are moving. I think that's why people are moving out of France.
Exactly.
But never fear, we are going through a period of change, which has increased volatility, which leads us to really the second part of this podcast, the part two of our discussion of volatility, which is how do you take advantage to generate returns. Just to do a quick recap on what we talked about in the first episode on volatility, is that volatility, using it properly, could be a diversifier in your portfolio. It is negatively correlated with the equity markets, especially in a moment where equity markets may be a little bit soft and correcting. This could potentially generate returns in your portfolio. We talked about that generally there is a volatility premium to be harvested, that the implied volatility, which is the market pricing of what volatility will be in the future, generally is higher than the volatility that's actually realized in your portfolio. And that difference is the premia that you can harvest. And the way I think about volatility and this premia is, I'll give you an example, which is I think about it as like an insurance company. Implied volatility is sort of the insurance policy that an insurance company have to write or to provide to the market. And the realized volatility is the claim that actually happens in the market. And we know insurance companies make a lot of money. And the reason is because the premium that they take in on their insurance policy usually is higher than the claims that they get from people. And this comes from a couple of reasons. One is that the insurance company needs to make money. But oftentimes when they write policies, they are pricing in risk that seldom happens. When your claims is lower than what the premium you have to pay to the insurance company, that's where the profit comes in, and that's where the volatility premium comes in. We also talked about that volatility really exists in almost every single asset class. It is most famously known as the VIX, which is a measure of equity volatility, but you also have volatility of oftentimes you have volatility in single names, which oftentimes are much higher than an index because there's the index has a built-in diversification which lowers volatility. And so maybe we'll stop there with the recap. And what we want to do today is really talk about how you can use volatility in your portfolio to generate returns. And we do use this volatility premia to generate returns in all of the strategies that Kurv offers to investors, but in different ways. We're going to cover two different ways in which volatility can be beneficial. One is a pure play on volatility, and we'll go through the mechanics in very detail, hopefully not too boring. And then the second way is to have volatility to be embedded in another risk premia. So volatility with equities, or volatility with fixed income, or volatility with currency. So those two different types we'll discuss today. So I'll hand it over to you, Dom. Let's maybe do a deep dive on how you can do a pure volatility trade in your portfolio.
Well, yeah, just also to recap last time. So there is two types of volatility. It's the realized volatility or historical volatility that happened. That's when your stock is up 1.3% today. That's known. It's realized. And you have the future volatility that will be that is expected by the market to be in the next X amount of days. And it's important because the way you do the trade, you will trade different volatility. Okay, so the pure volatility, which is what volatility will be in 3 months' time, that will be like a VIX future. You have other volatility futures, but the VIX is the most well-known on the volatility of the S&P 500, a kind of funky average of the volatility of each single name in the S&P 500. And as the word said, you have correlation and diversification at play here. And but it's a good indication of uncertainty in the market. And you can trade this through futures on the CBOE, and you have even though you have also options on that. You have you have So the volatility, so right now the VIX is around 22 or 23 percent, something like that. And 23% it's how much the stocks are expected to move on a daily basis, but annualized number. It's a bit complicated, but in a way, if you have, let's say, 16% volatility, it will mean that your expected move will be a 1% per day. So 23% VIX will be like 1.5% per day move. Okay. And that's what the VIX is today. And this is priced in the option markets. And you can play the future, which is in June, and it's expected to be 22.5%, so 1% lower than today. So if you think the volatility will be higher than what it currently priced in the market, you will buy the June contract at 22. If it's above that, you will win. If it's below that, you will move.
What you're showing is essentially there's a pricing of volatility over time, right? What is the volatility that the market is pricing over the next weeks, the
Yeah.
next
So
month,
the
next
VIX,
quarter?
yeah, the VIX contracts are the VIX is a 30-day volatility window, so it's what the options market will price of volatility on 30-day options. Okay, so that's why you have every month a future on the VIX, and you can trade this volatility up to January 26, it seems. But
Okay.
you have to be careful because the spot volatility might not be the same as the future volatility that is priced in the market. You have to take that into account.
How do you extract that premium on the pure play volatility, which is the difference between implied volatility versus realized volatility? So another way to say it is, how do you extract this premium that's between the market's pricing of volatility going into 30 days and then the realized volatility that you actually experience in the portfolio?
Okay, so this is a much more complicated trade, but it's possible to do it. It's what market makers do every day to price your options. So to price an option, you need to take into account the move of your stock that will happen on a daily basis or even intraday if you want to, until the end of the expiry of the option. And you need to do that on a market neutral basis, because to extract your premium, it needs to be out of other elements. It needs to be pure. It needs to be away from any moves your stock will have. Your P&L should not be dependent on the stock movements. Yeah, it should be only dependent on the movement of your underlying. And how they do it is by what we call the market neutral hedging or delta hedging. It means that when you take a position in an option, this option will have already embedded in it a sensitivity to the stock. Okay. And you need to erase that through doing the opposite trade on the stock. So you are market neutral. But the cool thing with option is this sensitivity moves around as the stock goes up or down. Okay, so every day you have to adjust your stock positions to whatever the market neutral should be on the options. Okay, so when you are short an option, it's not great because you have to buy high and sell low. When you're long the option, you have to buy low and sell high, which is better. But by doing that every day until the end of the day of the option, until the expiry, you calculate how much you made or lost through your market neutral hedging, and the sum of that should at least be the price of the option if you sold it.
Last time I asked you whether it's better to short volatility versus long volatility, and you said it was short volatility. So In this case, does it matter? Because you mentioned that if you're short an option, you have to buy high, sell low, which is very counter to what any investor is taught.
Yeah, it's counterintuitive, but in fact, well, you get first compensated by the premium. So ideally, the premium should be the same as your cost of hedging every day. Okay. But sometimes there are crazy market movements where it's difficult to hedge, right? You have jump risk, for example, between 1 hour to the next, if there is an NFP, a non-farm payroll data point in the market, or if you're on Friday and a news happen on the weekend with a Monday, well, it's not easy to hedge. So you need to be compensated for that. That's why the volatility that is in the option market is usually higher than the realized volatility that you will see every day on your stock in general. And that's the volatility risk premium.
So going back to my example with an insurance company, the insurance company is writing these insurance policies to get the premium that covers improbable events, but as well as a little margin for them to make some money. So that's why the premiums usually come out to be higher than the number of claims that they can get under the policy.
Yes, and usually it's the same across assets. You have this premium, so it changes. For the volatility premium for bond market will be different from equity. For the S&P, it will be different from single stock. You have to have a sense of it, but it's useful to know because in a way it's an add-on that you have on an option trade if you're short the option.
So Dom, let's walk through the mechanics of the trade, right? So in this scenario, I am writing a out of money call such that it has a 0.2 delta. So what do you do to extract this pure volatility premia and going through the process that you've mentioned?
So first, if you short the call, you expect the volatility at which you sold the call to be higher than what the realized will be. That's the trade.
And when you sell the call, you receive a premium from selling that call. So just to be clear, so you get money for selling that call.
Exactly. And so once you sold it, you are exposed to the stock, right? Because it has a sensitivity of 0.2. So you are short 0.2 of the stock. So to be neutral to the market, you need to buy 0.2 of the stock, right? So you have two positions in your book, short an option, which brings you negative 0.2 of sensitivity to the stock, and long 0.2 of the stock itself.
So when I write $100 worth of, let's say, Tesla calls, you're saying I have to buy $20 worth of Tesla stock to be market neutral.
Exactly. Now let's say the market goes up. Okay. And the sensitivity of your call, a call when the market goes up, its sensitivity increases. Okay, so it goes from 0.2 to say 0.5. All right. Since you sold the call, you're short 0.5 on your call. But on your equity position, you're only long 0.2. So you have to buy 0.3 to make the two neutral. And you buy it at a higher price. That's not great, is it? So you will use that. If it comes back to 0.2 the next day or next few days, then you will have to sell your equity. The 0.3 that you bought before at a high price, you'll have to sell it back at a lower price, 0.3. Well, this is what you do every day until the end of the expiry of the option. Okay, and if you do that, you calculate the P&L that you have on your equity, side, it will be an amount, maybe $4, and you compare that, negative $4, and you compare that to how much premium you receive from selling the call in the first place. It may be 5, so you make money. It may be 3, so you lost money. And in general, the implied amount, the implied volatility that you received is higher than the realized. That's the volatility risk.
So the premium you get typically will be greater than all the buying and selling of the stock that you do to delta hedge. And that's the purest form of volatility risk premia.
Yes, that's the realized volatility against the implied volatility that will be realized in your expiry.
So this, obviously not everybody can do this, right? Because you have to be in the markets every day. That's why maybe you delegate this to an investment manager. But there is a second trade or the second implementation is a little bit different. It's definitely not a pure volatility premia, but it's a volatility premia that is attached to, say, equity or single names or whatever. And that's just slightly different, but it's easier to manage. You still benefit from it. And this is something that we do in all of our strategies, especially we have strategies that have single name cover calls as well as a basket of technology names that we write cover calls. Why don't we go through that and maybe how is it different than the first version, and then what do you give up, what do you gain in the second implementation?
So first you will be long the equity, plus you will do the short call on top. So the equity will bring you a sensitivity of 1 to the stock, and the 0.2 that you sold from the short options, well, in total it will be 0.8. You will receive a premium.
Sorry, and just to clarify, so this is a traditional strategy that's called a cover call strategy, in which you own the underlying asset and then you write an out of the money call to get a premium.
Yeah, and you do get the volatility risk premium because you are selling an option, and in general, the realized is lower than the implied volatility at which you sold the option. By the way, it could be on covered call, but it could be on other strategy where you sell the options. And then, on top of that volatility premium that you get, well, you do get also the time value of the option, okay? So if the spot doesn't do anything, you get the full premium. But you also have the first risk that we talked about, the first trade, the pure volatility trade in a way. You do have it, but in between the time you traded it and the expiry. Okay, it's because options are priced at the implied volatility. If increased the second after I sold it, then the call will be worth higher. Okay, so you, in a way, you do get it as well. So, and by timing the moment you sell the call or the put, you do get this pure volatility movements as well.
So one of the interesting things about the second implementation is that volatility is mean reverting. As I mentioned last time, you're looking for spikes and then ultimately the decrease of the spike going mean reversion, right? But there's also some structural volatility behaviors that is very apparent. And what I show here on screen is the implied volatility for two tech stocks. One is in Amazon and one is Netflix. And you can see over 1 year, there is a very visible spike over 4 times a year. And this is typically around the time of earnings. During times of earnings, uncertainty increases. And as Dom has says, the implied volatility is calculated, 30 days into the future. And as soon as the earnings is within that 30-day window, implied volatility increases. So some of these behavior in spikes of volatility is periodic and predictable. And maybe, Dom, this goes even further when you were talking about why generally you prefer to be short volatility versus long volatility. And how does this work in terms of the second implementation, which is a cover call that you can leverage to generate returns?
So we are looking at implied volatility on 30 days options. And you have the spike from the day that this 30-day period includes the earnings announcements. Okay. And the thing with earnings announcement is you don't really know when exactly they happen. They can be delayed, right? So that's why the spike takes longer than usual. But you can take advantage of that because higher volatility means a higher price of the options. So it means you have more cushion on against either a move of the stock, or if you are a pure volatility realized against implied play, you have more cushion from that. And by doing a covered call, well, you do get both because you have the spike in pure volatility, so you're selling at a higher rate. It's like as if the VIX had cyclicality every month or every 3 months, then you sell it at the high, and you do get also the volatility risk premium, which means realized is lower than implied.
And just to be absolutely clear, you mentioned you want to be short volatility, and so that generates positive return when volatility falls, right? So when you write your calls at these peaks, you get more premium, and then when volatility falls, that contract will fall in price, but because you're short volatility, that's actually a positive return in your portfolio.
Yes. I should add on that that if you hold your option until the expiry, it doesn't matter how the volatility moves, okay? Because at the end of expiry, it's pure intrinsic value. There is no time value. It's just the price of the strike against the equity that's worth, okay? It's if you want to sell it in between, that the new implied volatility will matter. But anyway, it's good to have the pure volatility play when the volatility is up.
You can see why volatility may not be correlated or negatively correlated with other markets because it doesn't depend on a specific market going up. It just depends on a specific market going up and down. And so that the increased volatility could be both upside surprise or downside surprise. So you can see why volatility could be an additional diversifier in your portfolio. It's the important thing is the spikes in volatility that you are looking at. And as Dom correctly reminds me, the market does have a bias that volatilities tend to spike more when the market falls, especially current market where equity market is fall. So it acts as a negative, it's negatively correlated. You generate returns when equity market has negative returns. So that could be something that you can explore and use in your portfolios to further generate returns over a long period of time. That's it for this episode. We appreciate your time listening to us. We definitely appreciate the comments that you guys have left. It helps us and guides us on the topics that we covered in future episode. Again, please like and subscribe wherever you are finding this podcast. Keep the comments coming. We'll see you at the next one.